Essentially, we're going to talk about sources of funding for startups today, kind of running the gamut from friends and family up to institutional investors, like ourselves, and sources of debt financing, et cetera. So we'll introduce ourselves. We'll talk about some of the more popular sources of funding for startup companies. Talk about some factors to consider as you're maybe thinking about which of those is best for you. Some of it's dependent on many factors that we'll talk about, and then finally open it up for any questions along those lines that would make sense for you. So to start, Charles and myself were the two founders and general partners of Icon, which is a $100 million venture firm in Menlo Park, California, and here in Minneapolis, close to here. Both of us are from Minnesota. Charles from Rochester. Originally we've been in venture for 17 years. This last fund we started was the $100 million fund we raised last year, and Mayo fortunately was a part of that. And we've had some companies that have also worked with Mayo in various capacities as well. We're early stage investors, so we get started in some of our companies as early as a couple people and a halfway well thought out idea. And then we continue to fund the companies through the life of them through an eventual exit down the road as well. And we focus on business to business companies, so we're not doing consumer technologies ourselves. Plenty of people do. We just focus being the thing. So we focus expressly on companies that sell into businesses, small, medium, and large size businesses, and that. One of our mantras is, with all the things that have transpired in the development world over the last 10 years, it's very efficient to get a software product out to market. So I guess that's the other thing that's relevant here. We're primarily software investors. We're not like device investors or something like that, though I think some of what we talk about is probably applicable, to other areas as well. But we're, primarily software investors. But because it's become so efficient to get things started, you really can get companies and products out the door for very little these days. So we're all about kind of capital efficiency in each step of the process. How can you how can you get the product out with as little as possible? How can you get it to market without spending a ton of money? And then how can you actually grow and scale a sales force again in a fairly efficient means? And it's pretty amazing what you can do today versus even just 5 years ago, and certainly 10. And the other thing that's unique about Icon is we have a group of Icon technology partners. We have about 80 people that are kind of in three categories. One are deep technologists, so we have people like the CIO from Google, head of open source, there. We've got some leading people in security software. Another third is people, senior executives at large, IT companies. So we have GM from HP, one of the senior execs from Microsoft. Former CTO from EMC, EVP from Symantec, and then thirdly is other successful entrepreneurs in the past. And this group of 80 people, we get involved, with our startup company. So they'll help. Well, first of all, they introduce a fair number of the deals that we do to us, which is really nice. But then secondly, help us with diligence, and then thirdly, help the companies introductions to customer partner prospects. The former entrepreneurs or current ones have done it a few times. Provide a lot of assistance to a lot of our companies are first-time entrepreneurs, so helping them out. How do you set up a sales compensation plan? How do you think about channels to market and things like that. And so that's kind of our unique calling card. When we formed Icon, we were previously together in another firm. We wanted a small firm, yet to have kind of the breadth and reach that some of the large ones did, the resources, and that's where our technology partners come into play. So we can kind of have the best of both worlds. We don't have a lot of partners that you have to talk to. It's the two of us make a decision, so it works pretty efficiently. But yet we have the reach of it's not just the two of us when we're making an investment and working on a company.
Good. So we're going to talk as we talk about sources of capital, and as Jeff said, we focus on business technology, but this really is applicable to any company, I'd say, that's looking to raise money to do something other than open a store, start a small business. This is really geared towards companies where the goal is, I'm going to go build a big business. I'm going to need a meaningful amount of capital to do that over time, and these are the typical sources. That said, the first one, and we'll go through these each in more detail, family and friends, it's actually the largest source of financing for all startup companies in the United States. I think $25 billion a year in friends and family money flows into startups. The vast majority of that flows into companies that, again, it's a local restaurant or something someone's trying to open up. So not as relevant to the rest of the things we're talking about. So we'll go through the list. It's very common, I'll talk about this later, to have a mix of sources, especially over time. And there are a few other sources as well. We'll talk briefly about what some of those are, and obviously get questions both along the way, and as we're done, just raise your hand or speak up. So let's start with friends and family. And by the way, the green, yellow, red, really from our perspective, green is at an easy and fits early stage. Yellow is not necessarily a challenge or a risk. It may just be, it's going to take you more time. And red is typically going to be, here's a reason you might not want to take this source of capital, or at least if you do, think really carefully before you do it. So here, friends and family, great source of capital as well as personal money for getting a company started. It's easy to get the money, assuming your friends and family actually love you, like you, whatever. But there's not much. Usually it's less than $250K, often it's a lot less than that. So it's a small amount of money. One of the things we caution you about is don't dip into this well too often. Individuals aren't typically configured to put a lot of money into startups. If you think about kind of overall net worth and what percent should you invest in startups, the answer is very, very little. And so when you start asking for 50, 100K checks for most people, that's a lot more than the very little they should be investing. Terms can be simple. Our caution you to be very careful. I can go to a family member and say, hey, 50K, and I'm going to do it at a $10 million valuation, and a family member may not really care or know what that means. The problem is if you start raising money at terms that are more aggressive than what you're going to be able to get later on from angels and VCs, you can really screw things up for the business. So keep them simple. Be smart about what you're doing. Don't take advantage of this to be greedy. Be a bit more generous and make sure these are terms that when you go to raise your next round, those investors aren't going to think that the last people overpaid. It can be a big problem. Value add, generally, unless it's a business they know, they're not going to add any value other than giving you some capital. And the last one's important. Unlike professional investors, angel investors, this is family and friends. If you lose money, if you start not getting along, if they question what you're doing in the business, it can have a lot of personal implications, so keep that in mind, and obviously don't let your family or friends lose their house because they're trying to support your vision. But again, great way to get a little bit of money to get started, often a good way to get people involved in a small way you want to make sure are part of the process you're doing. The next is the angel investors, and this category of investor has changed very significantly in the last 5 to 6 years. Historically, angel investors were kind of $50, maybe $100, $150,000. There weren't very many of them out there. They were pretty selective in what they were doing. There are a whole lot of people running around now doing angel investing, which is great for startups. So perfect stage, getting started, seed, some inception. The diligence process can be 5 minutes to 5 months, right? I mean, we see angels who will commit in 10-minute conversations. Momentum here can actually be important, being able to tie into here are the other people who are involved, or here's who's investing. People move faster and faster when there's scarcity for whatever you're trying to raise. The amount typically less than $1 million, although we've seen significantly larger financings. But from our perspective, a true seed financing would be $500,000, $1 million. And I'll go through in more detail what's sort of the goal of that money. But this is really to get the business up and going. The terms are generally fairly simple. A convertible note or a Series C. Now I'll explain these quickly. So a convertible note is very simply, I make an investment in your company. We agree that I'm going to give you $500,000 and we set a valuation cap. So say it's $4 million valuation of the business. But I take it in the form of a note that won't turn into equity until you go raise another round of financing, at which point it will convert on the terms we already set. The idea here is there are 2-page forms to get done, much faster from a financing perspective, cleaner in a lot of ways. The downside is you're holding debt until you raise a bigger round of equity, but probably half the seed deals we see are getting done as notes these days.
I'd say it may be more.
Yeah, it could be. And then the alternative would be a Series C or some other sort, which the goal of the Series C documents is to simplify an equity financing down from 4 or 6 different documents, 20 pages each, to a much, much shorter, kind of more like a convertible note type of structure, but to do it as equity. And there's positives and negatives on both of these, to be honest. It's not that big a deal. What's more important is getting the terms right. Value add for angel investors, it's completely dependent on who you get money from. I would encourage you to expect very little value add from most of the people, in spite of what they might tell you. Don't count on them to go out of their way and spend half their time helping you be successful. If they're really doing a lot of angel investing, they're going to have 5, 10, maybe 20 companies, and they're probably going to be running their own business or doing something else. There's only a fraction of the time they will allocate. It's usually less than what people are kind of hoping for. But again, you're not looking for long-term value typically. There are certain exceptions there. And then considerations. So angel investors are great at that initial capital. They can give you some money to get going. They're not going to be the people who have money to really support you through the life cycle of the business as it grows. So make sure you understand your long-term capital needs and kind of where they fit into it. Ideally, and we'll talk about this later, getting a mix of investors where some have deeper pockets to support the business later will be very helpful. And then the other thing to think about is personalities. They're investing in your company. The life cycle of most of the companies we fund, the successful ones, 5 to 7 years from start to exit, which means these are people who are going to be involved in your business, like it or not, for 5 to 7 years. Make sure that you understand who they are, how they're going to behave as investors. Ideally, talk to companies they've worked with before and invested in. The last thing you need is someone who's causing you significant problems as you're trying to move the business forward, and has the ability to because they have some equity in the business so they can cause disruption. So make sure you know who you're getting involved with. This is very much a long-term engagement, and you just want to get it right. Next is venture capital. Venture really kind of runs the gamut from seed financing all the way through to pre-public companies. The red on difficulty is it's a highly engaged due diligence process. When we look at a company and we're about to close on an investment, I think we started talking to them in July. We've interviewed everyone in the team, we've talked to customers, we've gone back and had the same conversation multiple times, we've tracked quarterly performance. We're going to put a meaningful amount of money into the company, and prior to making a decision to do that, we're going to spend a lot of time understanding that business and getting our arms around as much as we can. So it's 0.5% of all startup companies in the United States are funded by VCs. It's a very infrequent way to raise capital. Now again, that includes everything that gets started, so it's the mom and pops, the hairdressers. But it's still a very small number of companies ever raise venture money, and it really only makes sense if your thought process is, I'm going to go build this to be a big company, whether it's public or acquired. But this is an opportunity where I think it's $1 billion company if I do it right, and I need partners who can help me do it. The amounts, the smallest seed investment we've made out of the fund was $175,000, and the largest venture investments these days are $200 million or more, although we don't necessarily call that venture. That's another discussion. But in reality, there's a lot of capital available from these sources. We see a number of our companies, as they start to have success, go out and raise those $30 to $50 million financing rounds to really scale the business. So great source for future capital. The terms I put in yellow simply because, similar to the diligence process, it'll be a much more involved process. We want to have, as professional investors, we're going to be sitting on your board, actively involved. We want to make sure there are a lot more controls in place to protect the company and protect ourselves as investors. Longer documentation, all these things. We're going through this now with this company we're about to invest in an agreement to have with another company, making sure that's clean prior to investment. Those are the types of things for angel investors that probably say, let's put the money in, we'll deal with it later. So it's going to be harder to get the terms right, but if you can do it right and find the right partner, it shouldn't be a big challenge. Value add, in reality, it depends on the firm. We're the most high value add venture capital in the world at Icon, so that's the no-brainer. But in reality, it depends on who you get, both the firm and the individual. And you should be doing diligence on your investors. Call up the people who they work with, call up the companies they've invested in, good and bad, and say, what they do for you, how they help, do you like them? You need the right long-term fit, and you want to make sure you're getting money from people who are going to add value. We have a company now that's raising a follow-on round. The investor leading that called me and said, hey, there are 2 people in the deal right now. We just don't want to really give much to in the new round because we've got other firms we'd like to bring in who we think can do more for the company. It's the right thing for the company, and something you really want to make sure you know what you're getting if you take venture. Next is venture debt, and I won't spend much time here. It's not typically relevant for pure seed stage startups. Generally, venture debt is raised in a Series A round or potentially later. So venture debt is effectively the same thing as bank debt. Banks are giving it to companies. But as opposed to typical bank debt, where you go in as a company and you're showing them your financials and your profits and your projections, if they give you X dollars, startup companies are going in and saying, we don't make any money. In fact, we lose a lot of money. If we continue to operate the way we do, we're going to be out of business in a year unless we can raise more capital. So how about you lend me some money? It's a much more involved process. It can take a long time to convince people to get on board, especially for early stage companies. And it will be highly dependent on a combination of the results. I didn't put this on, but very much dependent on the team, and also dependent on who's around the table as an equity investor. So if you have venture money in your company, getting venture debt is an easier thing to do. Generally, they'll put a decent amount in, $1 million or more is typically what we would see. Structure is usually very good, meaning non-dilutive. You're taking on debt, but you're giving up warrant coverage, so you're giving up equity equivalent to a small percentage of the debt you raise. So we have mixed views on venture debt. It's on a company by company basis. I don't know. I think for us, Series A is usually earlier than we want to see it. But I have one that's a series. We raised a Series B recently, and they just got handed $20 million by a debt provider, and the terms were fantastic. So it's worth considering, but it's probably not your frontline place you're going to start. Value add. These are bankers. They're not going to add any value to your business whatsoever. Anything they do above zero is positive, so don't expect that. And the terms here are critical. You have to repay debt, right? So make sure you understand the terms. Make sure you don't have a structure where I give you $1 million in a loan, but the terms are such that as soon as your bank account drops below $1 million, you can't use my money anymore. You just borrow the money, you get no value for them. So the terms of venture debt are highly critical. Make sure you have good attorneys and people around the table to help you. I'm going to stop for a minute because we covered the 4, and I'll go through some examples and other things. Any questions at this point? Keith, you always have questions. Go ahead.
Who are typically the angel investors? Individuals or companies?
It's a mix. So usually, historically, angel investors were individuals. I mean, they're the angels that came from above and gave you money when no one else would support you, right? This is back when people thought of venture as not wanting to play at that early stage. It's changed dramatically where still most of the angels are individuals, but there are venture funds that are doing pretty much pure angel. And VCs and we've always, from when we started doing venture, but in particular with Icon, we've always been involved in seed deals. So we're not typically angel investors, but we're investing at the same time.
So you talked about convertible debt. So talk to us about the interest part of it.
Mm-hmm.
So is it generally included in it, or do you have to pay the interest, or?
No, yeah, it's usually it'll just convert in, right? So first of all, for the convertible debt for the seed rounds, it's usually very low, right? It'll be like 4 or 5% or something, and then it's not current pay. It'll go when that converts into the round, because usually they're converting into a round of
So the
financing,
interest
right?
also converts into the equity.
Exactly,
Okay.
yeah.
Any other questions?
So Charles, one question about, AngelList is a big site now.
Mhm.
Just love to get your thoughts about using that as potentially as an angel investor, but also to promote the company for finance.
It's a very prescient question. We have a slide at the end that we're going to specifically talk about AngelList, and we'll talk about it. And this is a website for all of you who haven't heard of AngelList, and Jeff will talk more about it, that we think is great in terms of finding early stage companies, and is a hugely valuable resource for startup companies trying to raise money, and we'll go through that. So, example, yeah, Keith, come sit. Get pizza too. Just an example of funding life cycle, maybe a typical funding life cycle for a startup. You start up with personal funds, whether it's you, friends and family, say it's 25, 50K. You're obviously not paying yourself a salary. You probably don't have anybody on salary, promise of equity. Get the business started and start doing some early development around whether it's for us, software, the product itself, or just the idea and what sort of the plan is. The next would be seed financing. Let's say you raise $500,000 from angels, some combination of angels and VC, to the question of what are angels. So again, typically individuals, but sometimes that's funds. And usually what you're doing with that money is you're starting to build a team, to build a product and sort of base layer team, get the product built. From our perspective, generally this day and age, seed stage capital should get you to first customers, first revenue. When you go and raise that Series A, you should be able to talk to people about, here's why this customer bought, here's what we found in that sales process, here's what we're still learning. Then going on to the Series A, again, it can be 2 million, it can be 6 million, but typically from venture capital, maybe a little from your existing investors if they're angels. And the real focus here, and these are the two places, seed and A, where we get involved. The focus here is getting that go-to-market strategy right. So, okay, I have 4 customers post-seed. I understand why they bought. We're honing in on kind of a product market fit and how we go and position and sell this. Now we need some capital to go hire a few people and test if we're right. And if we're not, make adjustments as we go. But ideally, to really start scaling the business and show that early growth. And then Series B, all the way on. I don't know, what's your memory of your career, the latest around, sort of the biggest letter?
I.
Yeah. So Series I, right? A through I. Those usually aren't good. Typically, if you raise a Series I, something didn't work. I'm sure in this case it was a hugely successful. But you'll raise more capital as you need it, generally in 12 to 18 month cycles as the business grows, and the amount can be anywhere from a few million to tens and tens of millions of dollars. And if you follow the press these days, there are companies literally raising $400 or $500 million private financing rounds that maybe aren't necessarily venture capital in the true sense of the phrase, but they're venture-backed companies that just continue to scale in the private markets. And when you get to this point, you're building out your entire executive team, you're scaling your business, and you're looking towards where are we going to go with this business. And generally, the goal is let's go see if we can get this to be a big public company. But 9 times out of 10, companies that are successful and going down that path end up getting acquired first. So building the business to what eventually will be either a liquidity event through M&A or a public market offering, which then provides future liquidity for employees and investors. They're very prototypical. There's no magic to how much you should raise. It's completely dependent on the business at each step along the way. You've seen companies be hugely successful on a few $1 million, and you've seen others take hundreds of millions of dollars to get to the same point.
So what do you consider SBIR or STTR on this map? SBIR or STTR on this map?
SPIR.
SBIR, ST.
Small business.
Small business.
Kilograms.
Okay, I don't. So here's what I would say. Generally, for SBA money, it's an interesting mix. So there are venture funds that have SBA capital, so from the government, which is straight in the venture capital pool. A lot of times the SBA loans aren't really typically going to companies that are going to raise money, the types of businesses we would look at. A lot of the SBA loans end up going to more local businesses, small business, true small businesses that aren't starting small but hoping to scale to be very large. They're small businesses that by default will remain small. I didn't add it in as a potential additional source of capital. It certainly is. But when you look at the structure in terms of what they provide from a capital perspective, it really doesn't mesh very well with what we typically see. I don't know if you...
Yeah, no,
So if you were to kind of like go through this and say at inception, the person owns 100% of the company. When you get to Series B, where...
Well, if we've done our job, we own it all by then.
Okay.
So
I guess
yeah,
where
so-
is that happy medium?
And you guys won't be able to see, but I'll read it to you. So 25K, I mean, you own pretty much the whole business.
100%.
Ideally, some of this is coming from you and your team. Seed, $500,000 investment. We just talked to a company today, and the range for valuation would be 3 to 6 million. Is that kind of fair? So you're giving up
2 to 6, maybe.
Yeah, so you're giving up anywhere from 20%, 25% down to 10% of the business, ballpark.
Yeah.
And at this point, you're starting to bring in teams, so obviously the team's taking ownership. At the venture stage, highly dependent on how well you've done with this, right? We have companies that have gone and raised this round at $25, $30 million valuation, where the 2 to 5 million is another 10 to 50%. And you have a number of companies that do it at 7 or 8 million, where you're giving up 25, 30% or more of the business. So 10% out of it here, let's say you take another 30% out of it here, and then it's wholly dependent. This is why we're really focused with our companies on being capital efficient on the front end, because as we tell the entrepreneurs, you get to own more the whole way through the process. The less you spend and the less you need to raise. Down here, typically these financings are going to take 10 to 15% of the equity each time around. So bigger valuations, but larger financings as well. So the answer can be truly anywhere. I mean, we have one that was hugely successful with 3 founders. When we exited IPO, they owned about 18% of the business combined. It was lower than what you typically would like to see, but they raised a lot of capital to get there. You see some that have as much as 40, 50%. So, any other questions on this slide? Scoot along. Actually, I'll let Jeff start covering this, just some of the other considerations, things to think about.
Yeah, so some of the other things to think about are just what is the size of the ultimate, opportunity that you're building. If you're building, an application that has, there's a limited market for it, you can see how it can be a $10 million revenue business, but not a, $100 million revenue business or something like that, then friends and family and angel investors are the better, place to go, because institutional, venture guys, if I've got a $100 million fund, I'm trying to think, how can I, does this thing, with my ownership, is it going to be big enough that I can return $25, $50 million to the fund? And obviously, if it's only ever going to be worth, 10 million or something, that's not going to be the case. So try to think about it realistically, because you'll save yourself a lot of time. If it's going to be small, you shouldn't try to raise a lot to begin with. You should go after a group of guys, because the angel investors, look, if they're only investing $500,000, they're getting a $3 million valuation. They can make a nice return if you're, in that kind of category.
Yeah, and on that, I mean, the challenge, we see it all the time, is people who have a 10 or $30 million opportunity who decide they want to raise venture, so they have to figure out how to make it a $1 billion opportunity when it's just not. And the problem with that isn't, once you raise venture money, being a $20 million outcome is no longer an acceptable outcome. It is a failure. It will result in you not being part of the company. It will result in the company not being successful. So you need to make this decision fairly early on, because if you choose the wrong funding source, if you take money from investors, and angels generally do, who expect to be repaid a significant multiple on their investment in 5 to 7 years, and you happily go and build a $10 million business, having spent $5 million in capital to do that, it's not going to work out well. So be very, very honest with yourself around, what am I trying to do? And by the way, there's nothing wrong with great $10 million businesses. And a lot of incredibly wealthy people who just made their money doing that. Just think carefully about where you take the capital to make it happen.
Is that part of the terms and conditions when the VCs come in to put the money in? Is that part of the terms that you will discuss with the
Yeah, it can be in terms of liquidation preferences and things. Typically, it'll be, what we'll typically structure is what we think of as downside protection, where, if you take money at a $10 million valuation and then sell the business for $5 million, we're not interested in getting half our money back, right? And so it becomes very dilutive, and it's really designed to help enforce this view of, you're going to go raise this money, we're in this with you to go and build a very big business. So yeah, it is, and part of our job is to figure out, do we believe that this is a multi-billion-dollar opportunity? If we bet on something and we're all wrong, and it's only a $10 million opportunity, and we screwed up. But yeah, it's market and market size is a huge part of the conversation.
And then I think also somewhat analogously is the long-term objective, right? I mean, there's a lot of, truly great we call them kind of lifestyle businesses. That doesn't mean you're not working 80 hours a week or something like that, but it means, there's a lot of, they're maybe more smallish in size, but yet it's a very good, living for you. You can make, decent money off of it, but it's not, you're not really looking at it. You're looking more to operate the business for, 10, 15 years rather than thinking, this is how I'm going to scale it over 7 years, and I'm looking to, build and sell it, or, or take it public. And again, if you're looking kind of, longer term operating, it's replacing a job, then again, that's, probably not an institutional path you want to be on. It's more, the friends and family, they're angel investors, because we are very focused on, we want to build great businesses, but we're here to make money, right? So
if we don't give Mayo money back, they get mad at us.
Yeah, exactly, they fire us, right? So, yeah, I think that's all we said on that one. Then a couple other, additional sources of funding. There's been a lot of incubators that have been, popping up, throughout the United States, which is great. A lot of them are, good places to get, contacts and other things. What they don't provide, candidly, is a lot of capital. Most of these, they'll set you up at Techstars with, 20 grand, and, some of these things are even less. And so again, if it's, primarily money you need to get going, they often are taking 6 to 8% of your company, and you're thinking 6 to 8% for, 25 grand. That's a really low valuation, right? So again, if they really have the right contacts that you need, then it can make a lot of sense. I've seen some companies come out of there and, really you know, they wouldn't have gotten anywhere if it wasn't, you know, for some of the mentors they got early on. Frankly, it helped them hire some senior executives that they couldn't have gotten access to. But candidly, that's probably a little bit more rare. Most of them, you know, come out there, you know, not much better off than when they went in. You know, crowdfunding, you know, that doesn't really, you know, exist yet. You know, just legally it hasn't, you know, really been approved. Plus, it's, you know, if some of the issues we talked about with friends and family, it's even worse if you have, you know, 200 investors and they each put in, you know, $1,000. You know, you got some real problems on your hand down the road. So even when it is, you know, finally approved in the U.S., I don't think it'll be a good idea.
Yeah, Kickstarter, for those of you familiar with it, has been a really interesting way for startups to fund themselves.
The product development.
But it's really,
different.
yeah, it's not anything to do with equity. It's a pre-commitment to purchase a product, whether or not the product ever gets built. And we've seen some, very few, I think the average Kickstarter campaign raises $4,000 or something like that. So there's some great outliers, but it's not, for most of what we do, something companies would see as a legitimate or real way to go raise meaningful amounts.
So, I'm sorry, what do you guys do when someone is working with an incubator? Does it help you to secure funding at the later stage, even though you're giving up higher equity upfront, but then it will help you to propel forward much quickly? Is that?
Well, I mean, that's the idea that the incubator wants.
Is legitimacy, are you sort of asking, is the legitimacy of the incubator helpful?
Right.
Yeah.
Yeah, and I think the reality is for most of them, honestly, no. I think most of them don't. You know, a lot of them are staffed by people that, you know, that truly are staffed by people that are, you know, 26 and haven't ever done it themselves and really aren't all that helpful. I mean, there literally are probably 1,000 of them in the U.S. now. On the other hand, there are some that are absolutely high quality, that have some really good people, you know, make good connections. It's kind of like anything, you kind of have to do your diligence on. You know, I think our point here mainly is the cost is high, so really make sure, like, okay, you know, if I've got a product and I've seen 12 companies, you know, go through this incubator that have had in a similar genre, and I talk to them and they say, hey, we got these 3 mentors and it was great, here's all I did for them, you know, then it probably makes sense. If it's just, you know, hey, here's the, you know, local incubator and I'll go there, and you find out that, well, they don't really have anybody in my industry, they don't have anybody that's actually done this before at any scale, well, then they're just going to take, you know, they've got, you know, 3 recent college graduates that are going to help me out with my marketing strategy.
And take 8% of the company.
You know, probably not. So just,
and I think the key is, it's not a source of funding. It may be a great source of helping you start your business. So if you look at Y Combinator, I think they do a great job with their companies. If you're a Y Combinator company, I was at the demo days a couple months ago, you know, it's a room of 400 investors, every venture fund you would want to talk to there. And the best companies there are going to get the right audience. There are also companies that were there who, you know, aren't going to raise any money. So it's not a delineator. It's not going to define success, but it can help. But there's another one, to Jeff's point, where it's more of a business technology focused group. They've got 8 sort of advisors that they talk about being able to get you in touch with, and you know, they only take 6% of the company to do it. 4 of those advisors are investors in our fund and in the Icon Tech program. And when we sit down with companies who've gone through this incubator, what we say is, you can talk to any of them anytime you want. It's not going to cost you anything. And we'll make introductions now. We don't need anything. So make sure you're getting something that truly has value, because otherwise it'd be pretty disappointing to sell your business for $1 billion and have 8% of it grow to a group of people who did nothing to help you with it.
and then the corporate venture, you know, again, that kind of is all over the map too. Some, you know, really great active corporate venture ones, you know, some not as good. Generally speaking, we try to, you know, we usually recommend that later on because they're not going to be as helpful. You know, if you're needing help on, you know, your strategy, you know, how to put together, you know, go-to-market things, you know, that's really not what corporate venture, you know, does. You know, frankly, a lot of times they're even, you know, it's even worse. Like you get them involved, they invest in the company, and now they have a conflict of interest to actually get business done with you, right? So it's, you know, in their mind. So a lot of times it's kind of backwards there. So we usually think of that as kind of a, you know, later stage. It can make sense. In terms of the raw startup, you know, usually not. And then, you know, government grants, you know, occasionally, you know, can make sense, but, you know, we don't see a lot of that, to be
And
honest.
typically they're very much tied to a specific program delivered in a certain way. So let's say your goal is to take your product and go to here, the government grant may want you to take it in a different direction, so you partly get done what you're trying to accomplish, but you also spend a lot of time and energy doing things that aren't a fit for your business long term. And personally, it's different in certain sectors, I don't think we see a lot of value when a company comes in and says, well, I have this, this grant to go spend $400,000 building. It's not true in certain markets, where it's a better source of funding.
Could you take a moment to compare and contrast like the typical incubator you talked about just now and the sort of lean on Fed kind of thrust? It's not exactly apples to apples, but I'm interested in hearing your thoughts about those two different
So
threads.
my take is, you start a company, anyone who's offering you services up front but wants equity before they prove how good they are, you need to really be cautious about what you're getting. A lot of the resources that people are offering or saying they can provide are available for free or less if you can get connected to the right people. I was just looking at one today, which I hadn't heard of before, and there's 4 advisors. I know 2 of them, and those are 2 people, one's a VC, the other is an angel investor, who you could easily get on the phone and they would spend as much time with you just one-on-one if they're interested in what you're working on, than if you go to this organization, give them equity, and then get an introduction. I also see those 2 names on a whole lot of things like this, which is, so I think go online and find resources on, lean startup, and there's so many books, so many talks that are there, so many of the people at these incubators who, have done videos and talked about this stuff, where you can go and get all the information, you get the workbooks and everything for free. I would recommend go and do your research, spend some time. If there's still real gaps in what you're trying to figure out for a business, identify specifically what those are, and then when you think about an incubator, match up what that incubator is offering against what you specifically need to do. If it's I'm going to go to an incubator because I want to start a company, they're going to help me do that, you're going to give up a lot for, frankly, I think less than what you're going to get in return. So.
You just mentioned giving services. Now, when do you say, okay, there's too many folks in the kitchen, they've had too many people in their management team? Is there ever a point like that?
When you have too many people in your management team, well, if they're all managers and there's nobody doing the work,
Well,
that's.
yeah,
that's
no,
a
but
problem.
I'm saying.
When the entire founding team comes in, all 5 of them, they all have C-level, so CEO, CTO, Chief Revenue Officer, that's too many managers and not enough
How many
people
people do
working.
you think is usually a good case scenario?
That's an interesting question. I mean, from a seed perspective, in reality, there's not a lot to manage. I mean, there's 3 or 4 people you better be doing, because if all you're doing is helping other people figure out what to do, you're wasting somebody's time. As the business grows, I mean, I'm trying to think, so for like Coupa, we probably have, Propellant, we probably had 30 or 40 people with VP titles, but that was a 700-person business. So it really depends on the size. Early on, and what do you need? You need a CEO, you need someone in finance. It won't be a CFO, but they'll be director of finance at some level. You need a marketing person, you need a salesperson, and you need a technology. And whether they have C-level, VP-level titles doesn't really matter. And in my view, the thing that matters more is don't give someone a CTO title or a chief marketing officer title if they're really a director of marketing. Don't give them that title just because you're an early stage company and they wanted a big title. Give them a title that's accurate for their skill set. If they can grow into the role over time, great. But mostly what we see is title inflation, if that makes sense.
Yeah, I was also actually thinking also in terms of equity, like there, what you're saying, in some states will say, okay, we'll provide this service, if you have to give us some equity, then we can have cash. Are there ever too many people doing that, where it's like, okay, you've given up all of this equity,
Oh, yeah.
services, also kind of double cost?
I'd say more than one would start to make me question what they're doing. You know, if you've gone to an incubator and you've given up 6-7%, and you're to another one that did the same thing, either something didn't work the first time, or you're trying to rely too much on an outside help. That would be. Okay. Go ahead, the next one.
Sure, yeah, and kind of the last one on this, super angels, it's just kind of another term for a really active angel, I guess, just if you've heard of it.
Certain angels decided to call themselves super angels,
right,
created
yeah.
the term super angels.
And then micro VCs is kind of, when we were talking before, like the angel VC line sometimes, blurs. There's a lot of kind of $20 and $30 million funds out there, which are great. It's just they're focusing on a lot of the same things that the angels were, more, the smaller rounds. And, a lot of them are really good. Some are not. It all depends. And then finally, Angel List. Jeff had brought this up earlier, and Angel List is very active. There's a tremendous number of active angels on there. A lot of people raising money. It's been very nice. It's also enabled, I think, a lot of people outside. Most of the money is still going to companies in Silicon Valley, followed by like Boston on there. But you are seeing a lot more getting funded outside. I know a few of them in Madison, frankly, that have done a pretty good job of getting hooked up through through Angel List with decent angel syndicates. It's not easy. It still takes time. You still need to get one or two guys that start kind of moving the pile, so to speak. But it really has democratized things quite a bit for angel funding, and it's made it a lot easier. If you don't have a great indigenous angel population, which to be honest, we don't have a terrific one in the Twin Cities, and it's even smaller when you get to Rochester. So I think it has been pretty helpful for a lot of people outside of Silicon Valley, even though, like I said, it primarily is still Silicon Valley companies getting funded.
Yeah, it's a great service. It's totally free. They charge nothing to do it. They've done something that companies have tried to do in the whole 17 years Jeff and I have been in business, which is to become the kind of marketplace. Historically, all those marketplaces were trying to extract some fee for the process. AngelList had a very different approach than all who started it did, and as a result, it really made it okay to be out in front of a lot of people to say, hey, I'm trying to raise money. It's been great to see it work, and we use it frequently just to see what's out there, see what other people are doing. It's a great way to find competitors for early stage startups, and also, frankly, it's increasingly being used by people who are looking to join early startups. Maybe don't want to start their own or don't have an idea they're excited about, but trying to find something that's still very early that's looking to hire. And that's it. Happy to take any questions. We're going to be here and eating pizza, so if any of you have questions individually, please come up to you. Dave?
I want to get your perspective on Magic Leap. You're familiar, they just closed a Series B worth $524 million.
Magic Leap?
Yeah, Magic Leap.
Oh, Magic Leap.
AI company out of Florida. Apparently has something that does augmented reality against the retina of your eye, makes Oculus Rift look like child's play. Investors.
Yeah, I'm sorry.
What I want to understand about this, though, is you have a company that nobody knows what the product is, except for the investors maybe, no revenue, and they close a $500 million series. I mean, what's the story on that? There must be something there, right? I mean,
There might be.
because you
You
got
guys-
very sophisticated.
You guys remember the
investors.
Segway?
Yeah.
So do you remember when Segway came out? It was announced as a huge financing, $100-something million. No, it was called the IT at the time.
Yeah.
There was a patent that was on file. Finally, it became a public patent. You could see what it was. You could see that it was this interesting contraption built by a guy who's done amazing work, primarily for people in wheelchairs and things, in terms of automated systems and balancing systems. And then you heard the Kleiner Perkins guys talk about how it's going to change the world of transportation as we know it, and blah, blah, blah. And when you really step back and looked at it, you thought, this is the dumbest thing I've ever seen, but no one wanted to say this is really dumb. I'm not saying that's what Magic Leap's going to be, but when you put $500 million in a company that's still developing product, mostly based on the heels of a very, very overpriced acquisition of a company that's product is still really kludgy and in beta, although pretty damn interesting. I don't know. We wouldn't do that bet. But
I got a better one for you. RiverColor.com.
I loved Color. I loved sitting across from Color's restaurant using the Color app and seeing that no one within a 2-mile radius had used the app in 5 days, even though they had 50 employees across the street.
$21 million.
These things happen in this business. There's so much capital out there, and this is a thing that can be really frustrating for entrepreneurs trying to make money. These venture funds are raising multi-billion-dollar funds and throwing $500 million into things like Magic Leap. Why the hell can't I get my $2 million for an idea? I know it's a great idea. There's no answer to it. The simple, honestly, you have to look at those and realize it's a massive outlier. If it's a flaming failure, it'll be really fun for everyone to put money in and laugh about it. And think about the math for how successful it has to be for it to be worth the investment. But, you know, hey, I could be wrong, and power to them if I am, but and it's really hard. You're gonna be out raising money. I was talking to an entrepreneur last night who's like, I should be getting more money at a higher valuation. These guys are better than them, blah, blah, blah. Yep, I can agree with every single thing you said. It's just the way this market works. It is not the stock market. It is not within pennies of accurate on a daily basis based on what people trade. It is all about who you can go and get in front of, how you pitch your business, how excited they get about what you're doing, and it can make all the difference between getting nothing and, you know, potentially getting $524 million.
Just picking up from where you mentioned, I mean, what is the decision point when, I mean, obviously you're not going to get the first mover advantage all the time, right? So you're going to make a product which is already available and maybe incremental changes, whatever. So in that case, I mean, how does the funding community look at it? I mean, is it purely based on the team, or is it what value?
Yeah, I mean, a lot always is, right? We've had a whole speech before, and we probably don't have time today to get into all the nuances of it, but yeah, I mean, the more it's, you know, somewhat similar, the more it's important that, you know, the team executed this exact space before very well, you know, then you're more likely to take a bet on them, right? If they haven't, right, then, you know, no, you're not gonna say, well, this is 10% better, and the team's never done it before, let's give them money, right? That'll never happen.
Yeah, and the faster, better, cheaper is kind of one side of it. The other is what we think of as brave new world, which is no one's tried to do it before. It's creating a new category. You know, those are not any easier necessarily to buy into, because you got to believe there's actually a market for something, as opposed to there's an established market and here's how we're going to be radically different. But those are the two categories. Did you have a?
Yeah. So as a seed investor, what kind of data do you need to have to value the company?
As much as is available, and that's not a great answer, but I'll give you two examples of seed deals we've done. One, we invested in a company in New York called Backtrace. Two founders. They just brought on another, effectively founder but engineer. No product, and they were just starting to develop. It was introduced by one of our tech partners who's an advisor to the company. And what we had to go on was two incredibly smart people with great backgrounds in the space, conversations with all of their former employees, including our tech partner, about what they were doing, why it was interesting. A lot of our own work with our tech partners on, does this technology make any sense? And this is a bit of a brave new world. It's an existing market, but a very different approach. You know, their biggest competitor is Google. So talking with Google to say, you guys have this product, you know, this open source project, doesn't matter, and getting comfortable that it didn't. And then the belief that, you know, we can get something built in the next 4 to 5 months and get early customers who won't be paying us to start playing around with it. So very little data, most of it created on their own. The opposite of that would be like a Capta, I guess, or Elevate, where there's seed deals. I don't know if you want to talk about those.
Yeah,
Customers.
well, Capta's case, yeah, I mean, they had several, and it was, you know, 3 individuals who all came out of that similar industry. It was a little bit in the, you know, incremental as opposed to brave new world, but, you know, they already had, you know, probably like 10, you know, they just bootstrapped themselves for a while, had customers we could talk to, you know, early customers that had already bought the solution, you know, and they all were experienced in the area doing this kind of the same thing that they were, you know, doing now. So that was, you know, an easier side to the decision, I guess you could say.
But a lot of times we see we think these people are smart people who understand what they have to go get done and can execute. And for us, the way we operate as a firm, we think we have backgrounds and resources around the table where we can actually help make that happen.
So this might be for Jeff. Being that this is a Minnesota crowd, just love to hear your thoughts about some of the angel groups in Minneapolis, like Twin City Angels, and over Minnesota, University of Minnesota group as well. Just love to hear your thoughts on, you know, which ones, from your perspective, are the better groups, more respectable groups?
Yeah, well, I mean, I think, you know, so first of all, there aren't a lot of official groups, right? You probably, you know, named, you know, the 2 main ones.
Jeff was part of one of them.
You know, I think you should approach them both, you know, as a bottom line. And there's other more, you know, ad hoc groups or individuals. And I think you know, again, like everything, there's kind of pluses and minuses, you know, to both of them. But yeah, both Gopher Angels and Twin City Angels are worth, you know, worth approaching.
Yeah, I mean, some of it's, it's just kind of hard. It's just trying to kind of network through, through some of those guys. But both those are legitimate.
You're raising seed money in Minnesota, you should just be talking to Jeff. He'll figure out
Yeah,
the
right.
rest.
That's right, yeah.
So this is another kind of local crowd question. So, I'm interested in hearing your thoughts on, actually, everybody hearing your thoughts about the nature of kind of innovation in the information technology space in healthcare. So, I'm not aware of a whole bunch of markets these days, maybe 5, 10 years ago, that were basically dominated by oligarchy. Where I think the general sentiment is that there is like an enormous amount of innovation dammed up that is ready to be kind of unleashed, but for that oligarchy. How do you think about deciding when that inflection point is going to be, what it looks like on the other side of the inflection point, whether you make it a mission to plant dynamite, I want to hear about your things about on that.
I think there's the epic issue, the oligarchy, and I think there's a broader issue in healthcare IT, having observed healthcare IT my entire life. Since I was about 8, I guess. Healthcare IT has traditionally been several steps behind, kind of the most forward kind of approach. Unfortunately, I think in a lot of ways for health IT, there have always been, before Epic, there have always been a smaller number of players. There's always been this view of it's too complex, standard technology won't work, and the government has helped significantly in this regard. So much regulation that it's really hard to get comfortable that, hey, we can break the mold from what we're doing. So, you look at things like cloud computing. Obviously, you look at the use of mobile, where Mayo, frankly, I think is further ahead than most in getting comfortable. We're going to start handing people iPads and letting things work that way. You look at continuing care and patient care, and what's available compared to what's available for me to check. And people say, well, you got to worry your health records are going to get stolen. I'm a hell of a lot more worried my bank account is going to get stolen. But I can get that online, no problem, right? I can go online right now and trade stocks, no problem. But it's not that easy unless you're at a place like Mayo and very few others to go online and see what, my last immunizations were. That makes no sense. There's no reasonable excuse for that other than it's just the industry has allowed itself to be stuck in that mold. I wish there were a point where suddenly it turns. I think it evolves. I think it evolves because there are so many companies now that have come into the market to start to take advantage of that, disintermediate, that you have to wake up and take advantage of it. Plus, ultimately, organizations are going to be forced to do it. Right? You're getting squeezed. Every single dollar of spend is being scrutinized more and more. You have to collect the dollars you wrote, which is very hard to do sometimes. Technology is a good answer to a lot of that, but there's a long ways to go. And again, having a monolithic system that's supposed to do everything for everyone within a healthcare organization is hugely unrealistic. But if you choose to go that route, you're signing up to effectively not get to be part of the next generation for a lot longer. Not that I have an opinion on the matter, but so. Good, well, we'll be around, and I know most of you probably have to go on, but thank you for taking the time. Hopefully it was useful, and see you guys next time.
Be sure to check out next week.